button here. Just give me a second. We'll get this recording. Okay. All right, so what we're going to talk about today, let's kind of go through that. First, basically we're going to talk about setting stops and producing we call entry points. One of the things probably a lot of you have noticed is that over the last year or so, there's been a change in market conditions than we've seen historically. And what I mean by that is that what you have seen is a market that has basically been able to shrug off a lot of the bad data, and whenever a position gets in, whether it's a market or a stock to a point where it may in fact be a level to say, hey, you know what, we're going to quit on this. We're going to kind of take our losses and just move on at this point. But all of a sudden, things turn around. Probably a lot of you have noticed that. Okay, that's okay. Market conditions change. Cycles change. We see different types of trading environments in different times. But that's where we are right now. It's kind of like there's this underlying bid. We'll call it the Bernanke put. Call it, just a lot of money on the sidelines, whatever it may be. The bottom line is that what we're finding is that there's a great amount of stick saves, we'll call it. Just when you think things are going to go over a cliff for a stock or maybe for a market, all of a sudden you see something change. In addition to that, what you also have found is that a lot of breakouts have failed. So what we're going to try to talk a little bit about today is some of that and come up with some answers for you and some helping hands. So we've talked about in the past things like the alerts in the last several of our webinars. We've also talked about the market trend indicator, the key reversal indicator as well. We haven't talked about our pre-earnings reports that we look at, something that we have available as well. We'll kind of touch on that. So the big question is, how do you get in or out of position? Right? What is the indicator? What is the actual way that you can actually move in or move out of an actual position? And we'll call it right now an individual, a stock. Okay? So there's a couple of different things. There's different ways you can get in. One of the ways we'd like to do is possibly look at some different types of orders. So this is not specifically looking at an indicator right now. We're looking at a type of order. So we have things like stops, limits, trailing stops. There's a variety of ways that you can actually move in and out of position. And if you're not using some of these properly, you could be in a lot of trouble, because if you set up stops to get out of a position and you set it up, let's say, as a stop market, well, what happens there is the potential for you is to actually have a significant downside, because all of a sudden when you get stopped out, all of a sudden it just stops out a lot lower than you anticipated. So when we're looking at these, we want to look at what are the pros and the cons, and how to actually look at these from the perspective that there is different ways to approach this. So we have what's called a GTC, good till cancel. We have a day order only. We have, for example, you have fill or kill. There's all these different terminologies that you'll see and you'll hear about. Basically, the ones that we utilize are limits, stop markets, and oftentimes the day or the good till cancel. Oftentimes, good till cancel orders will actually be in between current market hours, and you can actually set them on most platforms to be post-market hours. So, for example, the other day we said, we want to pick up some more Facebook. And whether or not we like the stock or not, just I'm giving you an example of something. We want to pick up some more Facebook here. We see that the price range that we want to pick it up is about $20.10, right above the $20 level. So what we did was we put in a good to cancel buy limit order at $20.10. And that hit pre-market actually a couple days back at about right at the same price, at the price we put in, $20.10. Now, we weren't on the computer. We weren't watching what was going on. But what we did was we had that set so that we knew that the price that we wanted it to hit, it would hit. Okay. Question then is, where do you get in or out of a security? Do I do it if it's breaking out? Do I want to do it when it's bouncing on a support level? Do I want to move out of it when it breaks down this level of support, or maybe the secondary level of support? Where am I wanting to actually take this? what am I actually wanting to do with this? Frankly, probably one of the most difficult things that can be answered, because for every security there is a different level. There's different trading methods and mechanisms for every security. And what you want to do is you want to make sure that you understand we'll call it the way that a particular security or market trades. So when you're looking at an individual security, oftentimes you want to know, okay, what's the liquidity of it? Is there a lot of shares traded? Is it only 100,000 shares? Is it a million shares a day? Is it 5 million shares a day? Now, the more liquid the stock is, the more easy it is to answer that question, because oftentimes the more liquid the stock is, the more potential you have for institutions that actually own it. And if institutions own it, you know that they're most of the time holding on to certain levels, whether it's the 50-day moving average, whether it's some other kind of support level, the 150-day moving average. They don't usually use the indicators like MACD or RSI necessarily if they're going from a fundamental standpoint. All right. Now let's consider a couple of things that are really interesting, and I want to use these as examples of where recent alerts and possible buy points would have been or could have been. So let's take a look at some of this. So here's a chart on Sturm Ruger. They're a gun manufacturer, seller. You look at this chart. Okay, so it's a daily chart. You got the open, the high, the low, the close. And the question on here is, what do you do? Where would you buy this? Where would you not buy this? Maybe you're not going to buy it at all. So we could say potentially that when we look at this chart, okay, we could say, well, let's take a look. Let's take a look at, well, if it kind of comes above this level here, that may be something that we could look at. Okay, that's interesting. And maybe we could say at the same time, you know what, if that goes, really the real level here, that crosses above this level here, really kind of, wow, we really wanted to nudge right above that level there. Where do you stop it? Where do you come with to say, if I buy this stock over here, where do I stop it? Well, you can say, well, there's a gap over here, right there. Okay. You could say, well, if there's a lot of nice support right here. Look at that nice support line right there. So if I did buy it here, I'll kind of hold it to this level here, about 41. What if you're going to short it? Well, if you're going to short it, maybe I'll look to short it on the way down here. And then if it gets to about here, there should be support. All right, so that's just an example, okay? So let's take a look now at really what happened and take a look at what's going on with the stock itself, okay? So here we have a same exact time frame, same exact stock, everything's exactly the same. Now you notice a few things on here. So we drew these lines, which if you've been a part of what we're doing, you see these lines here, the red, the green, and the blue lines. And these are basically important algorithms that we've created to see where is the level of potential breakout for the stock. Where is the potential level where there's some support? And it's based on a market profile, a map, if you will, where we're going to look at, okay, so we have these levels. The red would be resistance, and the green would be support. So getting back to where we were looking before, let's take a look at that same situation that we looked at, okay? We said, you know what, if it gets above this level, we saw that here, that it looked as an interesting spot. And we also talked about here, well, this is, if you look here, right here, at this particular line, well, this is another level going back a few. That is a high volume area that was, in fact, an area to buy. But at the same time, we have other tools to look at. Now, these tools, some of them are available on, like, the Bloomberg platform. But these are algorithms that we came up with. And I know that it's kind of like, well, how do I do it on my own? Well, you can look at things like MACD. You can look at things like RSI. You can look at a variety of indicators with crossovers. But what we're showing here is, okay, now coming over here to this level, to this range right here, we saw some selling exhaustion. See how it kind of went down, the selling exhaustion. You get the pinks. And, that may have been a good point over here when we started to say that there was a kind of look at this whole range right there. That whole range is a support range. Well, that's what we talked about before, right? We said, well, if we're going to short the stock, that we want to look at this support range. And it was confirmed by a good amount of volume right there. So here we have a kind of a clear point that, okay, we have, let me just go back to this here, right there. We have a clear point that, hey, you're breaking out, and then again here is a secondary breakout. Now the next point where we see upside, where there may be some resistance, is right here. So that range is what? That's about, let's talk about let's draw this across here. Draw that across, from here to here. So we're talking about 42 and change to about 46. 42 and change to about 46. Well, that's not bad. That's a good return if you can make that happen. You got a stopping point possibly here. But we also had confirmation that you had this, which is our navigator moving higher, but also this is a T-score. This is something that we develop where we take the MACD, RSI, and probably about 12 different indicators. And what we do is we calculate them and then look at a crossover point. So right about here, see that right there? Which coordinates to about right, that's not a straight line at all, right there is a point where we say, hey, that's a good point to possibly enter into right there. Well, let's move a little bit further. The first thing we had, let me erase all these things, erase all drawings. Okay. First thing that we had was a very nice breakout. Well, we had a wide box, which means there's a lot of volatility in there, right? We saw a lot of volatility in between this area here. Let me kind of highlight this for you. When you see this kind of big ranges and see that gap right there, you got reversals that happened here. You had a high a pop-through reversal. You can have volatility, but once that volatility starts to stabilize, see that nice volatility stabilizing a bit? Well, then you have the opportunity to find a breakout, whether it's up or down, by the way. So I want you to start looking for, this is not consolidation. This is not consolidation. Here's some consolidation, so we're basing out. See that? Here's a little bit more consolidation. So you based out, you broke up, you came in, but you didn't go below this level right here. So when you're looking at a chart, what I want you to do is kind of look at what it is that is consolidating, which I think you all understand. We can kind of draw a box around it. If I get my pen working here. Let's draw a box around consolidation. Consolidation, consolidation, right? This is not consolidation. This is not consolidation. This is not necessarily consolidation, but it's just a continuation, if you look at it in a bigger picture, of that same consolidation run. Okay? That's important to look at. Let's get rid of all these. So far you're with me? Just somebody just give me a yes or no. Let's go. All right, good. All right, perfect. All right, great. Let me just fix something up here so I can go to the next level. Great. Okay, perfect. Somebody mentioned they don't have any sound. I'm not sure. You're muted. You should be able to hear, though. All right, next. Oh, let me go back to my more normal. There we go. Okay. Next thing we saw, which I mentioned a moment ago, was this consolidation range that came in. And if you notice, we talked about how the T-score was breaking out into the green, and we call this the navigator was breaking out. Everything was confirming. So you want to look for multiple confirmations when you look at any kind of chart. Again, this is just a charting discussion here. It's not talking about the fundamentals. We'll assume for a second that already we have the fundamentals that are making sense. So we have the fundamentals lined up, and now you have, for example, the confirmations, number 1 and number 2. Well, that's all good. Okay? Well, let's see kind of a little bit further along what happened. First, we have to decide where do we want to get in. We talked about that. And where's our stop to get out? So we did talk about that too, right? The short levels right here and the potential profit line. You always want to know before you enter something, well, okay, where is my profit? Where is my potential downside? Where are we going to go? Now let's see what exactly happened. We're going to overlay this now with something even more important, which is this is the behind-the-scenes look at the market map. This is what happens when you see all the kind of gory details behind the scenes, where the volume was. And you see this, we have this zone here that's pretty much open, which coincided with the levels we showed you before. So stop point could have been about 39.20, right, when it came down here, and potentially either that or a bounce point. And proper potential about 47. So we're talking about an entry at about 40-ish, stop at 39, so about $2 potential downside, and 47 on the upside. So that's a good potential trade that you can put together. What exactly did happen? What happened was that you saw the stock break out, and again, we're talking about this levels here, right? It ran up right to the 47, the 48, broke out a little bit. Earnings came out, and it failed once it met resistance. Let's go back to that for a second. So again, when we look at this chart, I'm just going to give you some arrows here. The breakout that we looked at before, the consolidation, then the breakout was there. It ran up. We saw a new level from about here where it potentially could break up. It moved up to the top, and then what happened? It hit its resistance line, which is a line that we drew with volume. Okay, you can use a market profile for this, and if your software has something like that, you can try to use. And then after the earnings, it kind of came right back down. Look at that. Almost in one day, it came all the way back down to where that breakout was. And then when it flushed out all the various, people that shouldn't have been in it or didn't have long-term belief in the stock or just did it for a trade, well, then it started to kind of move back up. Well, let's take a look at this one. By the way, not everything works out the way you want it to, right? Would you all agree to that? You have all the numbers line up, everything looks good, but not everything always manages to actually play nicely. Well, let's take a look at this. This is the same chart concept. Now we have here, I'm just going to use some arrows again. Okay? We had breaking down below support, and it went very nicely on a nice line. Everything was setting up. Everything was setting up. All the indicators were turning, to the point of, hey, this is not a good place to be. You have to get out of this, move on. Okay, now what happened? When you look at this, it's kind of interesting. You had a great short opportunity because it bounced right to its resistance and came down. You had a lot of resistance throughout the entire chart. You put your stops up right above resistance level. Now, let me show you this again. And again, you could see if there's a market profile available in your software. There's some software that has that. Our market profile is a little bit different than probably some others. But again, you can take a look at that and see if you have that. What I want to show you is this area here, right here. See, there's this open area here, right there, between here, this whole open area. So you want to kind of stop it right about here. If you were, getting into this at about 23, if you saw that bounce up and then possible move down, a little bit of an exhaustion position right here. Well, let's continue on again. Again, not everything works out so well. Okay? That's what happened. So if you look at the time period from this, where we would have looked at entering, which we did actually enter this position, you're talking about somewhere about, we'll say, here, right about there, right about here. That was the area that was kind of coming across resistance. It couldn't get above. Then all of a sudden, it broke up. Okay, fine. There's another set of resistance here. It broke out of that. Another piece of resistance here, and then it was all over. Wham, straight up. That is not a great situation to be in. That clearly is not a position that you want to be in. It is not a scenario that you want to just let it just go. Okay. And we actually closed out this position, and what we did was if you did correctly, you would have saved about 30% on the short. Now, would you have gone the other way? Yeah, possibly, but maybe you had some reasons why you didn't want to. Maybe there was some fundamentals. Maybe there was, I don't know, whatever it may have been. But the fact is that when you look at a chart, you need to know where your levels are and set them up beforehand. I want to show you something interesting. One of the places that you can actually get a great opportunity to either make a lot of money or lose a lot of money is by looking at earnings season. Earnings season, you have a lot of potential opportunity to make money if the stock beats expectations. And at the same time, you can lose a lot of money. Okay? Both are in play here. Both are really in play here. So when you look at the scenario where you have the opportunity to get in, you have to be very careful here, because buying either earnings before the earnings come out, let's say a day before or right before, or during the either pre-market or post-market sessions, the problem you have is you need to know not only levels, but really where things are playing. What are you looking for? Because, you know, if you look at just the headline number, what happens is that oftentimes you can be misled because they don't take into consideration many different components. So what we did is, let me kind of take a look at this. You take a look at this. Is you want to find those support and resistance levels. Those are very important, especially during earnings. You want to understand the ramifications of the confusing things. You want to get not just the EPS, but the comparative EPS of what it should be. Now, there's a lot on this particular chart to look at, or this table. This is something that we produce internally so that we can understand what happens here. But let me take you through some of the important things. And this is something that usually institutions will buy from us as a tool for understanding not only earnings, but what the potential opportunity is for a stock. We have technicals that we put on there, support and resistance levels that are important to take a look at. That's very important. Okay. We have at the same time, when we look at this, like the historical effect of stock prices and the misses on beats or how they've done, and we color code this so that this comes out before the earnings. You understand, okay, what is happening with this stock if they miss? Do they go down a lot? Is it do they have to beat by a wide margin? What's the range of movement, etc.? And again, it's all color coded so that we can kind of go along and figure out what is the best way to look at this. What's the best way to understand it? Is it by revenue? Is it by earnings per share? We also give you here, for example, expectations. And if you'll notice something, I want to highlight something for you. Let's see if I can do this. I want to highlight this area right here. These words, C. See that? C? C? So it's earnings per share that we're looking at, but the comparative means what was the actual earnings per share based on the metrics that are used by analysts to look at this. And if you just look at the EPS, it may not include a lot of the components that are either to be added back in or taken out. And oftentimes when you see a comparative EPS or an EPS line, you see, for example, how many times have you seen ABC company beats by 3 cents, beats by revenues, and you're like, wow, that looks great. And the next thing you know, the stock's down 10%, right? Or the opposite is true. I mean, how many times have you looked at a stock and all of a sudden you see that they missed earnings and they missed estimates and the stock is moving higher? Well, that's because the information that the news puts out, the media puts out, the headline number is not the one you should be looking at. So be very careful during earnings season to understand what a comparative EPS is and what our EPS is and an adjusted EPS. You have to look at all of these things, because if you don't, you can get yourself in a lot of trouble. And one of the things that happens to all of us is panic sets in sometimes, doesn't it? I can't see you, but I know you're all shaking your head yes. Panic sets in. What happens is that all of a sudden you see a stock moving down 5% or 10% or whatever the number is, and you start freaking out. You're like, wait a minute, oh my gosh, I shouldn't be in this because the stock is doing this or this is happening, and oh my gosh, I should really change how I'm, whatever goes through your mind. The fact of the matter is you need to be very careful when it comes to looking at the numbers, and then, yes, you can react to it, but with full knowledge of what actually is, the thing that's going on. Okay, sound good? Let's keep going. We also look at dispersion and regression analysis of what's happened with the EPS, the range and all that. You can see some outliers there. One of the things we really like to look at, is very important to look at, in fact, is how is the growth of the stock's earnings doing? Take a look at the gap here, for example. And we're looking to the right side of this. And when I look at this and I look at, okay, we have EPS growth and then we have estimates. So we see, well, 9% growth quarter over quarter from a year ago. And, okay, we have negative say, and okay. Now, when you get over here, remember something. You're comparing to back to here. So let me give you a really good example that's important. When I'm looking at the quarter, the fiscal quarter of the second quarter, you got a 37% increase. That's compared to that, a negative 3. And then the comps get even easier, negative 21 to 34, 27. Okay, this is the fourth quarter now here. Look what happens here. You had growth in this quarter, right? There, see that, 18%? Now it looks like a dip down because you're comparing quarter over quarter. You're comparing something in the past from a year ago quarter to now. So again, when you look at the growth, you need to see what you're looking at. You want to have consecutive growth of earnings per share and for revenue over time. One of the things that's negative about the gap is the fact, if you look at this, is this entire region right here, this whole region right here. What's happening with this region is that you're seeing the revenue, okay, just tick up ever so slightly. Now, obviously, the way you get better EPS is by cutting something, cutting expenses or cost factors or, something. But the fact of the matter is that you want to be careful when you're looking at this because really you want to see both happening at the same time. You want to see revenue growth and you want to see the actual EPS growth over time. The whole middle section of what we're looking at here, and this is something that, again, this whole area here, it's important because you see, okay, when is the earnings going to come out? What's the expectation of the EPS? What was the actual? Okay, and you'll see some differentials there because we use the comparative, so it's a couple cents off. What was the surprise? They surprised every time on the upside, but revenue's been a little bit light. And what happened in the stock on the run-up into earnings, and what happened to the stock in the run-up after or after the earnings? So when they miss, you can see here they missed on revenues a few times. You got red. So this stock is looking like that revenues are kind of important. They want to see growth of revenues, the analysts and the institutional investors. All right, this is something that I want you to pay very close attention to. This is the market trend indicator and our market timing model. We have the alerts that a lot of people have utilized. We have a nice growing group of people that are utilizing the trigger point research alerts. We put out an alert a couple days ago on Decker's shoes. It's up, I think, 5 or 6%. When you look at our overall averages and batting averages, really good. But when you look at things like Coinstar, which we have, you made another 8% today on it due to a potential buyout. So the bottom line is when you look at all of this and you look at buying individual stocks, a lot of people are like, I don't want to buy the individual stocks. I just want to kind of be in the market, out of the market. I want to be short. I want to be long. So what we have is a market trend indicator that corresponds with a key reversal indicator to give you times when it's, okay, you know what? You need to be 100% long S&P. You need to be 100% short S&P, 50%, whatever the exact indicator is. And it's a very simple model to follow. We all like simple, right? Give me a hallelujah or something if we all like simple. You just type it right in there for you. Make sure everybody's still awake. You like simple? Who doesn't like simple? Yeah, a lot of you like simple. I see. Yeah, and by the way, you can just type all the information in the little text box right there where it says just chat. Can you all hear me okay? Just somebody tell me if they can hear me okay. Make sure that everybody can hear me. Is anybody having any problems? Okay, great. Yeah, we'll answer some of these questions in a second, by the way. Some of the questions about where to get these tools and things like that. Let me show you this. I want to show you something really cool. These are the goals of our market timing model. Okay? You want to accurately predict long-term market trends You want to find where there is the potential for a short-term reversal. So you may have a market trend that is moving higher and is moving, it's grooving, it's doing its thing, but you know what? All of a sudden you come up to a point where you're like, wait a second, something's not looking right. Something's problematic here, okay? What do we do? And you also want to get a good broad view, very simply, of, you know, what is the market's, what's the market up to? You know, where are we trending? What's going on? All right, so two things, making it very easy. We want to look, okay, what's the market trend, the underlying trend? Because we know that about probably 80% of stocks will actually move with the trend. And we're talking about the markets here. And you know what? You want to hop on a train to get somewhere when it's moving, not when it's stuck or going in reverse. So what we have is an indicator that shows you basically where the market trend is, what it looks like, what the opportunity is, okay? Then what you have is a key reversal indicator. It's a very simple gauge that gives you the opportunity to find, okay, when's the market overheating, when's it oversold? And there's some of the history you can take a look at, and some of you have seen this before. But basically what you're looking at here is when a market is getting overheated, and it's getting to a point that it's moving up too fast, let's call it, in a too short a period of time, that's a concern. Okay? Now, why is that a concern? Well, it's a big concern because what happens oftentimes is that all of a sudden investors will kind of like pull back a second and wait for a better opportunity. And when that happens, when we see investors kind of wait for a better opportunity and pull back a little bit, what oftentimes happens is that you see kind of the bids disappear and markets start coming down. It can be a short period of time. Now, I will share with you that markets can remain overheated for much longer than they can oftentimes remain oversold. Markets can remain overheated much longer than they can remain oversold. The basic idea behind investing is to put your money to work, and most people, most investors will actually put their money to work, and what they'll do is they will find opportunities to buy something maybe when it's low. Now, most investors won't actually chase markets too much. You know, when they do, that's when things get overheated. But the best indication that we have is when a market is severely oversold. When a market is severely oversold, what we find is there's the best opportunities we have to invest. So you'll notice that on the chart on the bottom here, okay, let me highlight this for you. Let me give you a little spotlight. Okay, you have a lot of peaks. This one's getting really kind of to the point that it gets overheated, oversold. These giant peaks like this, when you see these very strong vertical parabolic peaks like this, shows us that there is the potential for a market to come down. Now this line here, the line that's next to is the S&P 500. So you'll notice pretty accurate representation of when things get too overdone on one side. It may take a day or so, but they do in fact start to come down. Okay? Now, again, here it kind of keeps on getting overheated, and then we saw this kind of like a consolidation, overheated, and then it came down a bit. Again, this doesn't happen immediately. It doesn't happen overnight. Right now, we were getting a point yesterday of it being overheated, and we actually said that, you know, markets are starting to get pretty overheated here. We put out that as a blog post, and you know what? Meanwhile, markets are up, you know, today. So it doesn't have to be a one-day situation, but it needs to be a warning. We know that there's a general trend up, but this is a warning, a time when you need to say, okay, wait a minute, what's happening? Why is it doing this? You know, what do we do to protect our portfolio, and how do we kind of you know, make sure that, okay, if we are in a trend up, hey, maybe it's time that we can put a hedge in, we can put a put option in, maybe take some off the table for a second until things kind of play out right, and that's the whole idea here. Now here's the long-term history of the same thing, a little more complicated to look at, but I want you to kind of stare at this for a second. You'll notice again, I think this is a very important thing to look at, I want you to see the extremes. At the end of May, we had a severely oversold market. Okay? What happened is it kind of, you know, you saw it come down, and then you got this kind of oversold. Now, it's not just a matter of price, by the way. There's a lot of things that go into this discussion. It's not just price. What you have here is also a combination of several different indicators that we created an algorithm with so that we can see where is the highest probability of the market reversing. Now, this is just an indication of reversing. It's not the trend. So we know the first thing we have is the trend. The second thing we have is that after that is we have, okay, when does that trend either reverse, stop, move entirely the other direction, or when is it time that, hey, you know what, this is a good time to say, you know what, let's take some profit off the table or hedge it out. That's what the key reversal indicator does. And we combine some things like advanced decline lines, some statistics on market movement and time that it took to get to a certain place, new highs, new lows, a variety of things that go into this whole formulation. But I want you to notice the peaks, okay? And let's look at this for a second. Let's look at right here. Okay, this is in October. Now, if you were to say, wow, markets are really down. Wow, that's just unbelievable. But let's take a look. We didn't really see that much of an oversold situation, but there was a lot of them. In other words, what happened was we got oversold, and then it came up just ever so slightly a little bit, but then it got oversold again. And then again, and oversold. This line, the center line, this line right here, if I can draw this somewhat, no, that's not straight. That center line right there, okay, that means market in equilibrium. Below the line, okay, is markets are oversold to a degree, and above the line is markets are overheating. Now, when you think about that, we always know that markets cycle. I mean, that's simple, right? We always know that markets cycle. Even though it seems like, oh, they're going to go forever or they're going to go down forever, we know that markets cycle. So how do we take advantage of the market cycle? You know, what do we do to take advantage of something like that? Well, what we do is we can find out where those points are from a probability standpoint. So what happens is here that, again, going back to the point where there is a market in a very oversold, markets oftentimes will come back to equilibrium. It can be slow or it can be fast, by the way. When they get terribly oversold, that's your key times to make a decision to do something. When they spike up like this, you know what, things that get a little bit hot, key time to do something. And this is the whole idea of the market timing model that we have. Now, this is really based for people who don't want to trade stocks. They don't want to go into the whole idea of, you know, I don't want to trade stocks all the time. You know, I simply want to go and I want to be, okay, I'm in the market, I'm out of the market. What's my best shot here? Is it going to be to move into a position long, let's say the S&P or the Russell 2000, whatever it may be, or I want to just be out and in. One trade, two trades, you're done. Much simpler than trading stocks, but it's still the same concept. So we give you a market trend, and we give you key reversals. Very simple to follow, and we'll actually introduce you on how to exactly get there and utilize this. That's coming live very shortly. Probably by, what's today's date? Today is 16th. By the end of this month, if not sooner, you'll see that this is all going to come live, and you can all check it out, and you can utilize this. We'll have performance, where you should be, in or out, etc. Now, I'll note that, let's see here. Oh, there you go. Oh, you know about this. I think you all know about this. If you don't know about this, you need to do this. If you get a 14-day free trial of alerts, you also get a 14-day free trial of the market timing model, which comes up. So just keep your eyes open for that so you can kind of get in there. And if you haven't used the alerts, even for the 14 days, you might as well. I mean, some of the numbers that we have coming up right now, like with liquidity services, up 12% in the last few weeks. You had Herbalife up 5%. You had Deckers, I told you, was up about 3%. Sanders Farms up about 3%. Caterpillar's flat. We're short on Nike, short on Buffalo Wild Wings. So take that down. You can go over there and check it out because I think this is something that you would very much enjoy if you haven't done so. And once you do that, your name's in the system. We'll also be able to give you the opportunity to get the 14-day trial of the market timing model. Now, let me answer a couple of questions here, and we'll wrap it up a little bit. There was a question: will you let you know what the underlying tools you're using when these green red lines are, used? You know, the underlying tools are, I mentioned the word market profile. Look that up. I think that's important to just take a look at. There are some of these answers on the website over at Trigger Point Research. Basically, what we've done is we've created a look at, okay, one, where is the most volume trading on the stock, we'll call it. Where's the most volume trading? How long has it been there? What level is it? Institutional level? We can find, we can grab all that information, block trading and things of that nature, as well as the fact of key levels of support resistance. Now, you put all that together in terms of the price and the volume, and you can actually, in a way, if you think about that, you can see where institutions are actually buying and selling. You want to follow the institutions around. They're the guys that kind of can move things pretty darn well. So we utilize all the tools that are out there, but we've created a bit of an algorithm, as we call it, that will give us kind of the levels, the important levels of support and resistance. Now, there are ways that you can get this. For example, over at Task Market Profile, if you use eSignal, you can use some of that. We use a few other things for confidence. We want to make sure we have a high confidence trade going into the trade. But if you wanted to actually utilize some of these tools, you can buy them. I think there's a few $100s, maybe $300 a month or something like that. And then, you have to kind of work with Steve Dahl over there. Great stuff. You can check that out, though. That's good stuff to check out. Somebody wants to know when I'm ready for a visit to the Grenada West Indies. Oh, I'm ready. Where else can we go? Well, I'll go. Are you paying? All right, let me have any other questions that you have here. Let me see. Let me go up to the top here. I don't know if this is in order here. Yeah, simple. Everybody likes the simple. I got a lot of people saying simple, simple, simple. Yeah. Okay. There must be one more question. Ask me anything you want. Okay. The question was regarding alerts. How do they actually come? That's a good question. We actually send the alerts through email and through text message, which is really neat. You get the alerts immediately as soon as they fly out. So you get them on your mobile device, or you'll get them actually and you'll get them in email, and they'll be on the website. So you get them like all over the place. Plus, we put performance on there and a whole bunch of things. There was one more I wanted to answer here. I thought I saw. Hang on one second, gang. How do we determine the equilibrium line? That's what I wanted to answer. The equilibrium line basically means that you're not seeing it overheated. You're not seeing a market that is oversold. And basically that equilibrium line it goes both ways, by the way, depending on your trend. So if markets are in equilibrium and you're in an uptrend, that means that essentially, the uptrend can continue until it gets overheated. Okay? So if you're in a downtrend, if you're in equilibrium, the markets will continue moving in that direction until it's overheated. Now, for example, let's take the last couple of weeks or so, right? Markets were in equilibrium until about 3 days ago. They were moving up a little bit, moving down a little bit. They're kind of like digesting a little bit. They're moving. And then all of a sudden we saw, bam, a change in the character of the market. We saw this big boom, and today, a couple of days ago, that all of a sudden stocks were moving. A lot of individual stocks were moving, and a lot of things were happening that were all of a sudden, you saw that the market trend indicator was still in a bullish or uptrend, but we saw a 3-notch increase in the key reversal indicator, and that actually posted on the website yesterday. So when you look at these scenarios and you look at these kind of situations in terms of when equilibrium is, basically if markets are taking in supply and the supply demand's kind of equal and you don't see a lot of overheating with our particular indicators, okay, that's fine. Things are all right. You kind of continue on with the trend. There's nothing to be alerted about, etc. Now, when they get either side, we'll call it 3 notches on either side, okay, we start to say, let's take a look at that and what's happening. And if it starts moving much beyond that, that's when we get concerned. Okay? We're going to wrap this up. We'll have the recording. I really do encourage you, if you didn't do the 14-day free trial, right this second, go over, sign up for it. You'll start getting alerts when they come out, high confidence trading alerts, and you'll be available to get, we'll put everybody that's on the 14-day trial on notice of when the other one comes out as well, the market timing indicator, okay? All right, I think we wrapped it up. Thanks so much for joining us. We'll see you soon. Any questions, you know where to find us.